Hey there, everyone. Dave Keller here with the Market Misbehavior. Welcome to Chart This with Dave Keller. If you're asking yourself, why did Dave start the show 5 minutes early? Let me take you back to 5 minutes and 20 seconds ago as I'm getting ready to hit this live stream button. Everything ready. Charts are good. Somehow my fingers managed to find the delete your entire chart list button on stock charts, and I clicked it. And as I'm getting ready to go, I looked for a second and I realized this one list that I use for every show, where during the day I kind of throw charts into a list and I got them already gone. And I kind of stared there for a couple minutes. And then for the last 5 minutes, I was trying to recreate all the little things that I've done. It was a great exercise because it was a way for me to reflect on, what were the things that I've been looking at today? I put them on a list so I don't have to think about them. The good news is I think I recovered 80 to 85% of the charts I was going to show anyway. So I think that's a pretty good number. But it did frazzle me a little bit. This is the problem of having too much sketched out in your day. The cool news is I did a great webcast with Interactive Brokers. Some of you might have participated in that this morning. It was called The 4 Deadly Sins for Traders. A lot of fun talking about timing and entries and exits and things like that. Had a great interview for the Market Misbehavior podcast. We had 3 interviews this week, all with my editor. Hopefully we'll start rolling those out to you tomorrow morning and through and into next week, because another really good conversation. And then, lunch and stuff. But then, man, that was exciting. The pulse is going, and I'm happy that we're here. I'm happy you're here. It is smoky, but still beautiful here in Redmond, Washington. I hope you guys are all doing well. Let's get to some charts that I've very frantically hand selected in the last 8 minutes to share with all of you. With that in mind, pretty decent day here for risk assets. The S&P pushing back up to the 7,800 level, which is pretty awesome to see. It did spike above there earlier in the day, by the way, in the first hour of trading. That ended up being the high for the day, but still a pretty good day for risk assets. We don't have a close above 7,800, but almost. So the S&P 200 points away from the performance I've promised with the trumpet back in the corner there. I will dig that out, have a little fanfare to celebrate a break above 8K. If you go back to the episode where we broke 7,000, had a little fun playing the horn on the air. I'll see what I can do for this next milestone, which may come as early as tomorrow. So I'm going to have to get the horn out and start warming up here tonight. Having said that, the S&P up 0.2%, 7,800. That's our close right around there. The NASDAQ composite a little bit better, up 0.8%. You're going to see 2 of the growthy sectors up at the top of the list, and that's pretty impressive to see. Mid caps and small caps all doing well also. The NASDAQ 100, sort of the mega cap growth stocks, doing the best, up 1.2%. Volatility actually slightly higher, not by much, though. It's honestly very hard for the VIX to go much lower than these current levels. So, if you're waiting for the VIX to be down around like 13, 12, 11, 10, it has happened, but incredibly rarely. And the reason why, as I've mentioned, there's just a natural volatility to the markets in any environment, right? The fact that buyers and sellers are coming in, and there's just, at the very least, a tiny amount of friction to all those orders being matched up is what causes kind of a normal amount of volatility. So you can't have no volatility, but we got low volatility right now with the VIX below 15. So VIX can stay in this range for quite some time. Basically tells us a low volatility environment. Tells us the options market are not seeing, a lot of dangers right about now in terms of volatility risk. However, this is why we keep watching the VIX, because at some point that rolls higher. We want to be aware when it does. And I will tell you as a quick aside, I think that's where a lot of traders get into trouble. Is you see the VIX is low, and then you're right, it's not something to worry about, so you just kind of don't think about it for a while, and then you don't realize that it's gone higher until you make time to go back to it. And that's why I have a morning coffee routine that I look at every morning, and I check in on all these different charts just to see where they're at. And then at the end of the week, I do a much deeper process to just check in on all the things. And it's the consistency that makes the difference. It's not really having a good read on the VIX today. It's having a good read on the VIX every day, yesterday and today and tomorrow. So I hope this show can be part of the way that you sort of nurture some good routines as an investor, for sure. Rates coming down a bit today. Of course, the inflation data came out this morning, basically in line with expectations, relatively low. We haven't seen a big spike in the VIX, given the headlines out of the Middle East that imply some level of hostility, still unclear as to what sort of traffic is getting through the Strait of Hormuz. Still very unclear about a lot of the details about that conflict. Just only the headlines and social media posts sort of implying one thing or the other. Having said that, these measures of inflation that investors have come to rely on to really, sort of define the movement in prices and the general trend in prices going higher, they were pretty much, within expectations yesterday with the CPI and today with the PPI. So what does that mean? Well, that means that about a month ago, the market was pricing in a pretty high probability of the Fed raising rates at the September meeting about 4 weeks out. We shared that Fed Watch tool from the CME on yesterday's episode. Now, more and more as this inflation data is coming in, investors putting a lower and lower probability of a rate hike at this September meeting and putting it out to the October meeting, maybe even further. And so less rate hikes, usually good for risk assets, and we're seeing risk assets generally move higher. So rates coming down today as bonds rallied. The 10-year Treasury yield right below 4.65. The long bond yield now below 5.25%, and the TLT, which is a Treasury bond ETF that we like to track, up today, along with equities. Dollar down slightly after having a pretty strong day on yesterday's session. Let's see. Looking at the commodity space, gold and silver moving lower, so a bit of a disconnect between gold and silver and equities. There have been times here recently where the correlation's been pretty positive between the two. Today feels more like gold and its traditional role as an inflation hedge. So when inflation is more and more of an issue, a lot of times investors go to gold as a good store of value. It's sort of a safe haven to protect from runaway inflation. If inflation's not that big of a deal, gold, I guess logically would not need to be much higher. So that's kind of what's happening today. Now, that relationship has not been, pure for the last 12 to 18 months. There have been times when that's become disconnected a bit. But gold and silver, for what it's worth, both coming off. I would say the chart of gold still pretty constructive after breaking above key trendline support, as we've covered. Also some moving averages. Crude oil prices continuing to come down as the expectations are less disruption and less, upside pressure on crude oil prices, given the latest developments in the Middle East. So WTI crude oil, which is the main U.S. benchmark, around $81 a barrel. Still anything above 80, I think, is still a potential concern. And Brent crude, of course, coming down as well. Looking at the cryptocurrency space, kind of a flat, choppy day for Bitcoin, to be honest with you. We're sort of holding steady around 63,400. We've sort of oscillated around that midpoint today. We did bounce off of 63K earlier in the trading day, and Bitcoin during the equity session has rallied along with of equities. The rest of the cryptocurrency space, pretty low volatility. These are not big percentage swings over a 24-hour period, which are almost to that 24-hour reset for Bitcoin and Ethereum and other cryptos, but flat to slightly higher is the way I would describe the crypto space today. Pretty good news in terms of breadth, starting with sector breadth. We can see that the communication services sector, the XLE, up 2.1%. Today, real estate, number two, up 1.4%. That's actually an interesting one because REITs were pretty good yesterday as well. So even though the market's been going higher, REITs are a fairly defensive play, kind of a higher yielding, lower volatility play. So interesting to see real estate toward the top of the list. It was a pretty good day for the benchmarks. Consumer staples, which is another more defensive sector, looking pretty good today, up 1.1%. Technology up 1%. And the XLK having a day like that is probably more than anything main reason why we're seeing uptrend in the major equity averages. Only 3 of the S&P sectors were in the red, and 2 of them not by much. Healthcare, industrials were kind of flat for the day, along with energy materials. The only sector down, it was only down about 0.5%. So at the index level, pretty low movement. At the sector level, a little bit more, particularly at the upper end, with communication services up over 2%, but generally a lower volatility day on the sector side as well. Looking at breadth conditions, about a 2-to-1 ratio of advancers over decliners on the New York Stock Exchange. That's pretty decent breadth. The best breadth was in the small cap space, so where 65% of that index was up. So literally a 2-to-1 ratio there. So small over large in terms of breadth, probably a way to describe this, although the breadth across the board was pretty healthy today. We can see, looking at the 9 Morningstar style boxes, that small cap growth, really the only one of these 9 buckets that was, just kind of flat for the day. But large cap growth and large cap core, the strongest places. Also, small cap value, sort of a weird barbell kind of relationship. So, generally, I mean, was there a real theme between large and small value and growth? I mean, not necessarily is the way I would describe it. This is sort of a general decent day, not a huge day, but a decent day. Now, there were some individual names that experienced some pretty strong movements here. Micron up 4.2%, Tesla up 3.8%. That's still not a great chart, I would argue. Meta also not a great chart, up 2.8%. So it's some of the trashier parts of the dirty dozen having pretty decent days. Micron actually pretty interesting, and I meant to grab one of those. I think I meant to grab SanDisk or C. I did keep Seagate. I remembered that one. Seagate looking a lot like Micron today, both kind of trading above recent out of a recent range, and Micron pushing above that 50-day moving average today, which is pretty important. On the downside, SpaceX down 3 1/3% after yesterday's sort of this week's upside move, and Amazon down slightly as well, continuing to not really do much this week. All right, we'll go to the heat map here in a minute. I do see some comments in the chat, so thank you so much to those of you tuning in live. I appreciate you guys doing so. We are planning to do a live show tomorrow. It'll be an all mailbag episode, but tentatively planning that for the normal time at 2 p.m. Pacific, 5 p.m. Eastern. So check that out live if you like. You're welcome, as always, to check out the show later on our YouTube channel. And again, drop questions anywhere you can. We're still finalizing the questions to show on tomorrow's broadcast, and we'd love to answer your question on the show for sure. 3P Investor, thank you for keeping an eye on the Super Bowl competition. I was just exchanging heated emails with my fellow competitors yesterday. That was supposed to go through, I think, the end of this week is what we agreed on. Man, I am dead at the bottom, and I'll tell you what killed me more than anything. I'll show you the name because I've known it for a while. AppLovin, it absolutely crushed me. Things down 50% since we did the event on June 1st. And I remember when we went through that stock picking exercise, and I remember seeing AppLovin, and I'm like, this is a great chart. I mean, it's breaking above the 200 days, pretty good. So I'm going to bet on that continuing. And of course, like a week after the selection, we go right back below the 200-day moving average, and that was it. So, fair point. Other Grayson actually is at the top of the list because he had 2 energy stocks. And I will tell you, I remember as we were doing the draft, I remember seeing Grayson grab 2 energy stocks. I remember thinking he's the only one with 2 energy names. So if energy does well, Grayson's probably going to win it all, and it looks most likely like he will. Although Tom gave him a good competition at the top of the leaderboard, picking some pretty growthy stuff that went up pretty well. For me, AppLovin is a great example of where I don't think it's a miss picking this chart in the comp. Like, I stand by that as a decent chart at that moment. What I would also say is it stopped working, and that's one of the great benefits of technical analysis, right? I think the way that we structure that competition, again, it's not perfect, but it's a great exercise. I think for me, I learned a lot by looking at the stocks that I picked and looking at what warning signs I would have seen between that date, which was the beginning of June, and today. And I think AppLovin is a great chart to reflect on. If you did think, wow, this was a good breakout, which I thought it was, what happened after that, right? Was it a break below the 200-day? Was it the momentum getting weaker? Was it the relative strength deteriorating? The moving averages rotating down? And there's a lot of points between then and now where it's clear AppLovin isn't a great chart anymore. And that, for me, is a big part of the benefits of technical analysis, big part of the game, is recognizing and admitting when you're wrong. I was wrong on that one for sure. And no shame in being wrong. Staying wrong is a problem, which is what, unfortunately, we're forced to do in that competition. Having said that, it's a lot of fun, and look forward to hopefully being invited again, despite the fact that I was at the bottom of the list this time. It happens. All right, let's look at the heat map here and see what's going on. So in today's session, I would say a number of sectors stand out as areas to dig into. Number one, of course, technology is always going to be top of mind because of its size and weight in the indexes. About 40% of the S&P at this point, of course, a much bigger part of the NASDAQ 100. Having said that, a lot of names looking pretty interesting right about now. I highlighted Micron, and we're going to look at Seagate a little bit later because I think that's a great chart to reflect on as potentially rotating back into an accumulation phase, which for me is a really important signal to watch. So while there are some interesting charts in technology, I'm more drawn to the names that did not go up today because those are where you might have some issues. Cisco going through earnings this week and did not go well, down over 8% today after reporting earnings, I think yesterday after the close. Applied Materials down, Arista Networks, APH, Amphenol down as well. That's after threatening to make a new all-time high. And Monolithic Power, MPWR, is one of the semiconductor names that did not do particularly well today, and that might be someone to read into because a lot of the semiconductor names actually did quite well today and are having these nice bounces off of the lows. And Empower kind of diverging from the rest of the group. That's how I would think about the technology space. The financial sector stands out today, but it's not the big names, right? So I've tended to focus on charts like JPM, Bank of America. Now, both of those made new all-time highs this week, and I still think are fantastic charts. But the names actually moving higher today are Visa and MasterCard, two of the payment processors. I would say, a little less extended, particularly in the case of Visa, but having this nice sort of stepwise motion to the upside. Recent pullback could be a pretty interesting setup. It's some of these other names in here that are starting to do very well today that stand out to me, like Apollo Global, APO is one. Maybe to highlight. This is sort of a big rounded bottoming pattern, undercut the 200-day, which was not great, but got back above the 200-day and now finally eclipsing that June swing high. So it came up on the new 3-month highs list that I was reviewing earlier today, which I think is important to note. So in the financial sector, it's kind of not the big banks; it's some of the other stuff, a little further down on the in the list on the XLF, which I think could be worth digging into. The energy sector didn't have a great day, but I'm still noting, just incredible strength in Valero and Phillips 66 and Marathon Petroleum. If you caught the Investing with IBD podcast that I did yesterday with Justin Nielsen and IBD, we had a great time talking about a lot of different things, but we focused on these refining names, and these are some of the downstream names that have done very well. And I think I grabbed the CRAK ETF. If not, I'll try to remember to pop that back in there so we can review that together. But that's one of the ETFs that sort of plays on that group in particular. And I would say some of the better charts that you can see in the energy sector. And then the final sector I wanted to highlight today was communication services. Alphabet still kind of struggling to regain its mojo after recent earnings and had a nice spike, but kind of stalled out here this week. But below Alphabet and skip Meta because it's still an ugly chart, the number of charts in here are starting to look a little more interesting. Netflix, bullish momentum divergence. Verizon, making a new swing high today. T-Mobile, not quite there, but I would say a number of these stocks having some pretty interesting rotations. Omnicom actually made a new 52-week high today. So I would say communication services, if that's a sector you've been kind of underweight or avoiding, I'm seeing enough interesting charts in there that makes me want to dig back into it a little bit. All right, we'll continue in. I'm already seeing some great questions that I'm excited to take here as we go on. We won't get to all of them, but I'll certainly try to get to some of them. Before we do so, I do want to give a shout out to one of our partners, Seeking Alpha. They have a new quant growth and income product. They've done a really good job using their quant model, and I've reviewed the quant model in great detail. I've interviewed Steve Kress, who designed the model, a couple times on the Market Misbehavior podcast. It's well designed, reminds me a lot of the institutional models we would use in a money management setting to identify compelling opportunities. And they basically are providing an institutional quality quant model for individual investors and advisors. You can find more info at marketmisbehavior.com/growth income. This one particularly looks at growth-oriented stocks that have a decent income component, looking for that 1-2 punch of strong price appreciation, what we call capital appreciation, but also a strong dividend component. Again, you get 10% off if you go to marketmisbehavior.com/growth income. And thanks again to my friends at Seeking Alpha, being long-time supporters of Market Misbehavior. All right, here's my daily chart of the S&P 500. And one of the things, unfortunately, that I lost was my beautifully designed, color-oriented chart of the S&P. I might try to recreate that, but this is one I had on a different list that I also refer to pretty often. It kind of captures the same the same sentiment here, right? I think the move above 7,600 was pretty important. I think when you're looking at a chart like the S&P 500, you want to think about which moves were meaningful and were, important sort of signals of a new trend or a new break or a new phase to think about. And I think that break above 7,600 about 2 weeks ago was pretty important. What's happened since then is we basically chopped around. Today, we're kind of resuming the uptrend. New all-time closing high, new intraday high today, closing right around 7,800 for the first time. So the primary trend is positive. Our market trend model remains bullish on all time frames. While I can give you a bunch of reasons why I think the upside could be limited, why I think there could be issues with this uptrend, the trend is going up. And I think that is one of the most important things to remember and to define is the direction of the trend. And generally speaking, I want to be on the side of the trend. I want to be following the trend. I'm a trend follower. So the S&P is going higher. The momentum is strong, but not excessive. I think anything above 7,600 at this point is pretty encouraging. That's where we're at today. So trend remains positive. The breadth conditions, no real change to that. And I would say the breadth readings that we've shared here recently, I think cover that. No real shifts in breadth today to report. So we'll go right to sentiment. The AAII survey comes out every week, and we just saw the latest report. Basically, almost the same amount of bears, around 38% of respondents. A few less bulls, are down to around 35%. So almost even, but slightly favoring the bearish side here. This is kind of where we've been here for a lot of the last couple months. We've been sort of in this net bearish, kind of skeptical of the market condition type of environment for the AAII survey. So what do you read into that? Well, I'll tell you what we're not seeing is excessive optimism. And I would say at this point, that's a pretty good thing. You want to be worried when we're making new all-time highs and it feels like everyone's all bulled up, right? When we're too bullish, because that makes me feel like the last buyer has bought and who's left to push the price higher, right? So too bullish is not usually a good thing. The AAII survey, over 50% bulls, that's a problem, right? 20% plus overweight of bulls over bears. That for me is like, we're a little too bullish. We're nowhere near that. We're actually in a pretty comfortable place in this survey, basically saying conditions are fine and, investors are bullish, but not too bullish. Crude oil prices continue to be quite choppy. And we've talked about how, we don't think about energy necessarily as a traditionally volatile area of the market. You normally think of like technology or like biotech as one of the real kind of, volatile areas where there's a lot of sudden movements. Of course, the events in the Middle East have created a lot of volatility in the energy sector, of course, and that's driven by volatility in crude oil prices. So we continue to see big movements to the upside or the downside as headlines from the Middle East imply things are great or things are horrible. Rarely in between. It's usually an extreme. The headlines here just over the last 24 hours, just no real new negative news coming out. As a result, crude oil prices coming in a bit. It's really interesting. I think one of the things that's so fascinating about how all of this is playing out is, as an investor, it's challenging. I think when it's hard to get a read on what's going on in the Strait of Hormuz, given its importance in global trade, given what prices normally do when you understand supply and demand, right? So that's Econ 101, the supply and demand curve, right? Is there the same amount of demand, but there's a lot less supply, prices kind of go up. I remember trying these like simple flow charts and just kind of understanding, the basic economic, sort of economics 101. The problem is when you don't have a lot of clarity in terms of what the supply is, which is kind of where we're at. One moment it's, the Strait of Hormuz is closed again. Then the next it's reopened and everything's fine. And the reality is probably somewhere in the middle, but it's unclear. And so as a result, there's been a lot of volatility here as we kind of overreact to every little headline. For what it's worth, though, crude oil prices coming down here. And that's not the only thing, obviously, driving the price of crude oil, but certainly one of the main things to pay attention to. I think what was noticeable to me as I was going through my morning coffee routine today is the fact that the RSI is kind of right almost exactly at 50. So we're in an absence of momentum, kind of neutral footing momentum-wise. Which tells you, still wait and see mode. It's a choppy and volatile but unclear chart at this point. Micron, as I mentioned, having a nice bounce higher again this week. Seagate Technologies, STX, is one of the storage names, also having a pretty good move higher. The good news is we're back above the 50-day moving average after reaching it yesterday. Today we followed through. The not quite good news yet is we're still kind of hanging below these swing highs. These were all kind of in the 920, 925 range from a number of peaks in July and now into early August. I think getting above that point kind of clears the way to retest that June high, which is over $1,000, actually over $1,100 a share. So I think we're very close to validating a new breakout in STX. And I would say that was one of the key themes that we noted in the end of June, beginning of July, is how much obviously some of these AI related names came down. And then after that, in July and now into August, how we have quite a bit of differentiation, right? You have some names that gapped higher and traded lower. You have other names that have just, had really good earnings and gone up. And then you've had charts that are still kind of neutral and waiting to see which way they resolve. Seagate and Micron are two of those charts very close to resolving to the upsides. I think very close to being a pretty bullish chart. Amazon is an example of one of those names that has really struggled after earnings, right? So that big gap that you see here was on their Q2 earnings report. We had this wonderful gap higher, gapping above, a clear support level, gapping above all the moving averages, but then completely stalling out at an attempt to make a new high, pushing above that May peak. And from there, kind of pulling back. And so far this week, while so many things have gone up, including the S&P and the NASDAQ, Amazon's just completely fighting that and going down. So lack of willing buyers coming in. We're getting really close to the upper end of this gap, and also the 21-day EMA, which for me is usually an initial stop in a chart like that. All right, three charts I wanted to highlight in the communication services sector. Netflix is number one, obviously one of the biggest names. Alphabet's the biggest name there, and then Meta, of course. But then you get to names like Netflix, which are obviously still pretty decent size, but not the dominant names. But classic bullish momentum divergence here, with lower lows in June and July, and then higher lows in momentum. And I think the chart of Netflix is a really good one to review. Look at the lows in April and May and early June and late June. And look at how the RSI is lower in each one of those times. That's kind of a normal expectation during a downtrend phase, during a distribution phase, where the pushes to new lows are met by stronger negative momentum. What you look for in that kind of distribution phase is when you get a divergence, when you see the stock continue to make new lows in price, but the momentum is a lot less negative, right? So we're making a new low in June, RSI is down around 20. We're making a new low here in mid-July. The RSI is right around 30. So a much different kind of momentum picture. And from there, that bullish momentum divergence, the stock has pretty much trended straight higher for the last 3 weeks straight, enough to get back above the 50-day moving average, enough to retest that high from July. Now, why is that high important? Because a downtrend is a pattern of lower highs and lower lows. And if we stop making lower lows and then we start making higher highs, all of a sudden this feels a lot more like an uptrend. So price almost breaking above 78, RSI just above 60. I think that's a pretty interesting setup, interesting opportunity for potential upside. Verizon is another name. Obviously, this is one of the kind of old school telecom mobile names from the old telecom sector, now part of the communication services sector. It's not like a head and shoulders bottom of any sort, but it kind of looks like it. But I would say in any case, key resistance here around 48.50 to 49. We're kind of right back up to that point. Would love to see a break above there. As a reminder, we're looking at the unadjusted chart. And the reason is because it pays such a high dividend. This pays a, sort of an estimated dividend yield of almost 6%. And the idea there is if you put, buy $100 of Verizon, about $6 of that estimated to be paid out as a normal quarterly dividend over the 12 months is kind of what that means. And so it's a high dividend payer, way above the average for the S&P, which is more probably like 2.5%. So pretty interesting income component, but also the price action has been fantastic over the last 6 weeks. Final one in this sector, Comcast, similar to Netflix, this fantastic bullish momentum divergence. So I'm noting a number of names in comm services having that rotation and now starting to rotate higher after that bullish divergence. Here, same idea with the previous chart. We're testing resistance, in this case, testing a 38.2% level, almost there. RSI pushing above 60. Pretty interesting chart. I think I had Valero on the show yesterday. So today I'm showing CRAK, as I was interviewed with Justin Nielsen of IBD yesterday. He had mentioned having a position in the oil refiners ETF, ticker CRAK. I do not, but we were talking about some of the better charts like Marathon and Valero, and these are the types of charts in this particular ETF. Just a fantastic setup, right? Big move higher. You probably call this a pennant pattern, which is a short-term consolidation after a big move higher, resolve to the upside after we break that trend line. Look at the pullback right to the 21-day EMA. We bounce higher. I mean, if all charts were this straightforward, this game would be easy. I wish it was. It's not always, but I would say the charts of ticker CRAK, the refiners, en fuego. I agree that, Larry, on fire, which is probably not a good thing for refiners, but I get your point. All right, let's take some random questions. I saw some a rundown of things. Hey, thanks for highlighting the Field of Dreams show. That was one of the first movies I watched with my daughter when she was old enough to watch like big person movies. I remember watching Field of Dreams. Like that still holds up after how many years since that was first put out, and now they actually do a game in the cornfield. Boy, that'd be cool thing to go to at some point. But yeah, that's a pretty fun thing. I'm glad they made that a thing that they do here. All right, we'll do another question or two. I saw a couple. I'm not going to get to all of these, and I do want to save some for our mailbag tomorrow. Yeah, interesting one. Actually, sorry, that was not the one I meant to. Oh, small cap breadth is expanding. Here we go. Interest rates are increasing. Cash appears to be plentiful for all categories of investments. I wonder how long this bubble will last before it explodes. I tell you what, I've had a number of questions. I mean, I interview a lot of people on the podcast, and I sometimes will ask them like, what previous period does this remind you of? And I stopped asking recently because the answer I got from pretty much everyone was kind of mid-late 90s. And it was whether it was, some people would say like mid 80s, which I think is a tough argument, but mid-late 90s, that feels about right. I mean, there's just so many similarities right now between the AI trade and everything and sort of the dot-com era, I mean, which is when I was just starting in the industry in 2000 and learning a lot about that recent history from the late 90s. A book that I would strongly encourage you to review if you're trying to make sense of what's going on right now. It's called Bull, and I don't have it on my recommended reading list, but I'll look it up really quick, and I'll put a link in the description if you want to pick it up. It's called Bull, and with an exclamation point, and then there's a subtitle by Maggie Mahar, Mahar. It's called Bull, A History of the Boom and Bust 1982 to 2004. One of the coolest things we get to do as investors is look back at market history. And I would argue charts provide one of the great history lessons for investors. You can look and see what the charts did during some of those previous periods. That book really captured kind of the 1982 low, which was a meaningful low, obviously. 1983 was when the Dow finally broke above 1,000 and then continued, right, and continued up to the the levels we're at now. But it really goes through sort of the conditions that allowed the 1980s bull market to happen. What happened at sort of the early 1990s, which were some crises, but then the mid-late 90s, which was just an incredible bullish run. But then it gets into the dot-com era and just talks about that major top. And I would say there are definitely some echoes. Like if you read some of the ways that strategists and analysts were describing conditions, and if you scratch out .com and you write AI in the book, it's going to sound exactly like some of the things you're hearing now, which is really interesting. My point of saying that is I would say we're absolutely in a bubble of some form. One of the things I've learned though over my career, there's a lot of money to be made on the left side of bubbles. One of the portfolio managers at Fidelity used to mention that quite often, and I think that's true, right? Just because you recognize we're in a bubble, avoiding the bubble is not a great approach, right? It usually means you're missing out on some fantastic opportunities. And so I would say, even if you do think AI is in some sort of bubble, which I would argue that's probably true, is there still a lot of money to be made on the build out and the AI infrastructure and all that? I think absolutely. And if we have a good, consistent process, we can hopefully recognize some of those shifts as they happen. All right, last, really more of a comment. In your humble opinion, engineers are natural technical analysts. It's so funny. I've mentioned this a number of times. I would say anecdotally, there are three types of people that I find naturally gravitate towards being and maybe two, I guess I would summarize it. Well, we'll call it three. One would be engineers, which is 100% right. There's a mathematical, component to that, to price action and statistical analysis, and that certainly attracts a lot of engineers. There are a number of people like Chris Kaufman comes to mind, who is really more of a like market physicist, applying. And one of my analysts at Fidelity was a physicist. He used to work at CERN in Switzerland, and instead of analyzing how atoms move or whatever he was doing, he was analyzing price movements and using a lot of the same methodologies, and it served him quite well. So engineers, number one. Pilots, which are kind of related to engineers, right? You have to be sort of a mathematician, but there with pilots, it's a lot more about making good decisions without emotions, which I think is pretty valuable. So there are a number of great investors and certainly technical analysts that are passionate about flying. Tony Dwyer, Jeff DeGraff, Tom McClellan are all in that bucket. And then the third would be musicians, which I find truly hilarious. And I always share people that when I was in music school in college, I was studying to be a conductor. And so you would do score study, and you look at this big sheet of music and have to analyze patterns and use your knowledge of market history and do all these things that somehow was a really good training to look at charts, because I'm looking at patterns and I'm using market history and I'm thinking about what's together and what's not. I'm thinking about melody and harmony and, convergence and divergence. Those are all musical concepts, but serve you really well analyzing charts. So there you go. I would agree. Engineers are very well designed to be good technical analysts. I would put buckets and musicians. That's your trifecta of good non-traditional backgrounds that help you look at charts. But hey, whatever background you have and whatever you've done professionally or do professionally, I hope that this show helps you make sense of the markets, helps you think a little bit about how you approach things every day, and just gives you some charts to consider. And for that, I will say thank you so much for watching. Those of you tuning in live, thanks for making it interesting and engaging as always. Those of you watching later, please take a moment and drop a question in the comment section on our YouTube channel. We'd love to feature your question in our mailbag episode coming up on Friday. Otherwise, have a great night. Remember, it's always a good time to own good charts. Take care, folks.